So the sponsors are constantly chasing these IRRs to be able to market to investors to actually attract them. But what the crazy thing is that as you get towards the end of a cycle and things get more and more expensive, it's the most dangerous time to be doing the value add strategy because you're running out of runway before you have to take off as an investor in a deal. And that's where everybody's gotten caught up now, right? Nobody necessarily would have known that the rates would have been the number one cause. It could have been anything, but we were close to an end of cycle. We were at a record long economic cycle. And unless you believe economic cycles are completely gone, you have to assume as an investor, they were eventually going to come to an end. And you were taking the highest level of risk at the riskiest time. So for me, the fascinating thing to me is that I typically do value add at the beginning of a cycle and not at the end of a cycle, whereas sponsors typically offer the most value add at the end of a cycle and not at the beginning of a cycle. And so it's almost like as an investor, as an LP, you have to understand that and try to protect yourself from the fact that sponsors are often just having to back into an IRR to attract investors.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/GowerCrowd. Welcome to today's episode. My guest today is Jeremy Roll, who is president of the Roll Investment Group. Jeremy is a seasoned multi-cycle real estate and alternative asset investor who is a voracious reader and analyst of market conditions, what's going on in the market, what's going on in the broader macroeconomic world, and in the industries that he invests in. I've known Jeremy for a long time, and what you're going to hear from him today are some insights into just how conservative he is in his investment approach, what he has been doing for the last few years and what he has not been doing, where he sees the market going, and where he sees opportunities emerging over the next few years. If you want to know more about Jeremy, please go to the podcast page at GowerCrowd.com. And while you're there, of course, please subscribe to our weekly newsletter. We cover the world of real estate syndication and crowdfunding and the broader commercial real estate industry in general. We publish a list of updates on recent news and events, and we generally include links to educational resources that you can actually use. Of course, you can always unsubscribe, but once you hit the subscribe button there at GowerCrowd.com, do go ahead and check out some of the company that you will be keeping. I've listed out some of the companies and institutions that are already subscribers to the newsletter. I think you will find it very interesting to see those. And I look forward to welcoming you to our newsletter. All right, let's move on to Jeremy Roll, president of the Roll Investment Group. Here he is. Jeremy, what a pleasure it is actually to meet you. We've been in touch for so many times over the years. It's a pleasure to meet you kind of in person, Zoom person. That's the world that we live in. And I'm really looking forward to talking to you about your experience and background and everything that you've been doing over the last few years and finding out where you think we're headed. So let me start at a high level, if you don't mind, and ask you, because I know you have a very interesting investment philosophy and approach. So why don't you tell us what kind of investments have you been making over the last few years? What's the general standards that you apply when you look at a deal?
Yeah.
And my focus, actually, I know that you're involved in a few different things. I'm totally focused mostly on commercial real estate.
Okay. And I'm assuming you're including apartments in the commercial real estate, obviously, right?
Yes.
On the larger scale. Okay.
Yes.
So thank you for having me on. Really good to be here. Before I even get started, I just want to thank you for helping the community. Right now, if anybody says to me, what is really going on? Like, I really want to understand this better. I point them to your podcast because you are so focused on helping people to understand what's really going on. And you're doing a really great service. And I just want to thank you. I'm sure you've helped a ton of people to navigate that. So thank you.
I really appreciate that. Thank you. It is what we're trying to do.
Yeah, absolutely. So my basic philosophy is relatively low risk, and I always have invested for predictability. I've been investing in real estate since 2002 in a passive manner. So as a limited partner, so over 20 years. And it's been the same for me the whole time. I look for more predictable cash flow. My philosophy is I want to go to sleep tonight, wake up tomorrow, and not much has changed. And as we both know, the reality is that a lot has changed in the past few years. So the question is, how do you avoid getting into those traps? And so what I do is I read about, honestly, 2 to 3 hours a day of economic news. And I just synthesize my own opinion about where we are in the cycle and how I can protect myself best, as best possible, to avoid what I call like the pitfalls or the landmines of a potential downturn. So to give you an idea, end of 2016, we were getting what I thought was close to an end of cycle. Eventually, the yield curve inverted and it was pointing to a recession in 2020 as most probable. And things were so expensive. I mean, the way that I invest is I invest across a lot of asset classes. And as one gets too expensive, I drop off except for unique opportunities and I keep going on the others. And I can tell you that by the end of 2016, I was in the mode of nothing makes sense anymore, like in terms of pricing and cash flow.
You're talking about commercial real estate, Jeremy? Commercial
real estate, yep. So I essentially only did unique opportunities since the end of 2016. And when the pandemic struck and things were going into even super crazy mode with money printing, I was even more careful with that. And what I would say is that as of the end of 2016, I was playing defense. Anything I was doing, I thought would have to do well during a downturn. As of 2020, not only did it have to do well in a downturn, but the pricing just had to be so extraordinary that it would get me over the finish line of thinking it would make sense. The bane of my existence was negative leverage. And it was something as an investor that never made sense to me that people were doing.
Just explain that concept, would you please? What do you mean by negative leverage?
Yeah, and it still exists today a little bit. So negative leverage is when you essentially, so you have a cap rate and you have an interest rate. Negative leverage is when the interest rate is higher than the cap rate. And the money you're borrowing is actually more expensive than actually the return on your cash for buying the property all cash. And in a historically normal market as an LP investor, and by the way, that spread in positive or negative leverage does vary a lot. If you look at it on a chart, it's quite variable. But let's just say the average is 150 basis points, okay, give or take. So as an investor, when I see negative leverage instead of that positive leverage, it tells me I'm not being rewarded for the risk that I'm taking. And what does that mean? Things are too expensive relative to the cost of borrowing. What does that mean? That means that prices are too high and I should be on the sidelines except for very unique opportunities. So in the last few years, to finally answer your question, I've only been doing stuff in real estate that had very considerable positive leverage. And it was very difficult to find. And the most common example I have for you, and I did quite amount of volume in this, was tax abated apartments where there was an apartment put under contract at off market at a certain price, but then the entire structure was converted to tax abated, where actually all the taxes were eliminated, and that's in exchange for essentially having rent restrictions on most typically half the units going forward. But in doing so, you're reducing such a high percentage of the expenses. You're closing, by the time you close and shift the structure, the agency appraisals were literally coming in at between typically 110 to 130% increase of equity. So meaning that if there was $100 million of equity needed, and I don't do institutional deals, I'm just using, let's just use 10 million of equity needed. The appraisals were coming back and saying that you had 20 to 23 million of equity built in at closing because of the value add strategy that was used just to convert the actual structure, with no operational risk at that point. And well, there is some operational risk. They have to comply to certain things going forward to keep it in status. But so long story short is I didn't do very much volume. It was very unique opportunities. And back, if you want to go a little further back to 2017, 2020, I was doing low income housing tax credit deals that were positive leverage. But then stuff got even more expensive in 2020 with money printing. And then the tax abated strategy was necessary to keep that type of positive leverage.
And is that different from the low income tax credit deals? I'm familiar with those. Those you build them. There's very high fees, I know, for the sponsor. It's very attractive. And then after 10 years, they revert to market, right? You've got restrictions.
No. Some of them have very long-term restrictions.
Much longer.
Yeah. In fact, I don't know this for a fact because I'm not an attorney, but I believe it varies by city or state in terms of those restrictions. Mm-hmm. And so you can see if all across the board, some people's strategies to buy buildings that only have less than 10 years remaining, take a 10-year fixed rate loan, right, and then write it out and then push everything up to market and get that value add strategy. So that is one strategy of doing it. My thought process behind low income housing tax credit was that if you're the cheapest by definition apartment on the block for at least half your units, then if there's a recession, you're still going to have high demand because you're going to be the cheapest on the block. and when the people need it even more than normal times. And so to me, it's a defensive play. You cannot maximize the revenue because you can't keep it to the exact rents you want. Typically, the rents are constrained to a maximum amount allowable increase per year by the housing agency or the government, whoever is regulating that where you are. And so you're not going to get maximum revenues going forward, but it's a defensive play to reduce risk and likely have more predictable increased demand.
So let's back up a little bit. This idea of predictable cash flow. So there's a couple of things. You talked about negative and positive leverage. What about levels of leverage? How do you look at that in terms of loans to value?
Great question. So that was another thing that was really bothering me because my comfort level is 65 to 70% loan to value. Sometimes I can get on board with up to 75. It really depends on the situation. I do that more commonly in a mobile home park where it's where there's a lot more value add play, where you could still have a good amount of cash flow because the expense ratio is lower. But in most typical asset classes, I'm most comfortable probably at 70, right? So when I saw some of these floating, well, we could talk about floating rate if you want. I did not invest in one floating rate apartment deal, for example, which was very unusual. And there's a lot of reasons why I didn't do that. But when you take a look at some of the loan to values of what they were doing, especially when you add the pref equity into the stack, it was like high 80s in some cases. You know, the what I call the cumulative loan to value if you add the pref equity, right, as you consider it debt. So yeah, the leverage that was happening at the end of the cycle was way off the charts for my comfort level. And I just want to point something else out, which is fascinating to me. If you're a sponsor, and let's just walk through the entire cycle, right? So from 2009 to, and going back to, let's say 2015, you could arguably have purchased a stabilized property with very little value add requirement and still have a high enough IRR to be able to market that to investors to attract the equity you needed. This, and I'm referring to all non-institutional. I focus on all non-institutional. I know you have a lot of institutional guests. I'm not institutional space. As of about 2016 to 17, it was almost a requirement that value add strategy took place, and those loans were available through agency. So they were a little bit better than the bridge loans that people have taken most recently. But it was a requirement in order, because the prices were so high, in order to get back into those IRRs that the investors need to be able to market to them and track them, they had sponsors had to pivot and only do those deals, right? And that's where I dropped off because everything was too expensive for the stabilized focus that I have. So, and then if you look what happened in 2020, when prices got even higher with the money printing, people had to go, agency was out on the bridge lending. People had to revert to the private bridge lending. And you had, in some respect, even better terms and higher LTV. That's why I'm bringing this up. But that was enabling, along with certain, assumptions and pro forma, the IRRs that they were required. So the sponsors are constantly chasing these IRRs to be able to market to investors to actually attract them. But what the crazy thing is that as you get towards the end of a cycle and things get more and more expensive, it's the most dangerous time to be doing the value add strategy because you're running out of runway before you have to take off as an investor in a deal. And that's where everybody's gotten caught up now, right? Nobody necessarily would have known that the rates would have been the number one cause. It could have been anything, but we were close to an end of cycle. We were at a record long economic cycle. And unless you believe economic cycles are completely gone, you have to assume as an investor, they were eventually going to come to an end and you were taking the highest level of risk at the riskiest time. So for me, the fascinating thing to me is that I typically do value add at the beginning of a cycle and not at the end of a cycle, whereas sponsors typically offer the most value add at the end of a cycle and not at the beginning of a cycle. And so it's almost like as an investor, as an LP, you have to understand that and try to protect yourself from the fact that sponsors are often just having to back into an IRR to attract investors.
Yeah, it's that's a really interesting point. Now, you talked about sleeping at night, or at least wanting to wake up and nothing's changed. So
yes.
The underlying message to that really is that your focus has been on protecting your investment.
Yes.
So it's easy to sit here today. We are November 2023. I don't normally, date stamp these things, but everything's changing by the week at the moment.
Yes.
2023, November 23. And you're talking about protecting investment, not investing in floating rate debt more than, 3-4 years ago already. So it's easy to talk about that in hindsight, but you were talking about it then. Why didn't you like floating rate debt then when everybody else loved it?
You're right. Well, first of all, I'm a big fan of 10-year fixed rate debt because I look for predictability. So the first thing is, for me, it doesn't fit into my whole focus, right, of predictability. If you have floating rate debt, the interest rate's not predictable, just by definition. Number two is you're doing the floating rate risk at the end of the cycle with the most amount of risk. So that was the second reason why it didn't make sense. And the third reason why it didn't make sense is because it was also negative leverage on top of everything else, increasing the risk. And so you're right. So it's funny we're talking about this now because it sounds like it's easier for us to talk about it, but this is actually what I was doing.
Yes.
And that's not why I'm not in any of the, and I will tell you as an LP, what was so frustrating is that over 90% of the deals I got, let's say in 2022 and 2021, were total across all asset classes, were floating rate, value add apartment opportunities. Okay, that was almost all I had to choose from. And what that means is that unless I was crazy disciplined, I was going to invest in those deals. It's almost like if you invested in those years, you almost were automatically in one of those deals, right? Because there was almost nothing else. So just like in 2005 to 2008, where I was the crazy person, I was very young and I was going to dinner parties with my friends. I was saying there's going to be a housing crash, and people thought I was crazy at the beginning. And it's an agonizing multi-year wait. This is what I just went through. It's agonizing as an investor when you cannot find deals that you're comfortable with. And you're watching people do these short-term flips, and some of them are working, they're making a ton of money and they're making a very high IRR. Yeah. It's very difficult to hold to your, stick to your philosophy. And you have to always have a long-term outlook. But
I tell you something, I'm going to interrupt because I have to echo that point. It's one of the hardest things is to sit by and watch all of this activity and wonder, is there a memo that I didn't get?
Yeah. 100%.
And just to stick to your guns.
Yeah, and by the way, so what I'm doing today, and that keeps me grounded, is the number one easy thing is negative and positive leverage. That's why I mentioned at the beginning, because if you were to say to me, Jeremy, when are you going to jump back in? How do you know? My number one answer to you is I'm looking for a fair amount of positive leverage. Otherwise, in my opinion, things are still too expensive. We haven't seen the buyers and sellers, the sellers adjust their price enough yet, right? So if you can anchor to certain objective things like inverted yield curve, how long does it take to have a recession? Fed starts to increase rates. How long does it take until there's a recession after that? And look at objective historical data. You can kind of get out of the weeds of everything else, get out of the weeds of your emotion, and it's agonizing, but you can still anchor yourself to that. At least you know that you're going through the most probable path for the highest probability of success for yourself. That's kind of how my brain works.
Jeremy, most people learn these lessons through hard experience.
Yeah.
So how did you learn them?
Well, I mean, part of the fact is that I was just convinced there was going to be a housing crash watching everything go up in 2005. So I was able to sidestep that. Part of what I did as well is I'm from Canada. So back when I started in 2002, I was learning this type of investing through lifelong friends of my family in Canada. And I was dabbling, even though I was located in the US, I had the currency risk. I was investing in Canada, and Canada ended up not having the exact same crazy amount of debt and leverage and cycle and effect that 2009 brought to the US. So to some extent, I got lucky, but to some extent, I also had a multi-year agonizing wait. It's probably a combination of the two. This time around, I could tell you that it was just pure discipline, looking at the numbers and doing the best I could and keeping my long-term focus and not looking for the short-term win. That's basically, and I'm always looking at the long-term focus because of that predictability that I look for. So one thing I just want to say is that I don't care which part of the cycle we're in. My favorite loan is a 10-year fixed rate loan because it's got maximum predictability.
Short term. So you've used the term short term. Define it? Anything less than 10 years?
No, short term. Well, I get really nervous even in a 5-year loan. I'm not saying I haven't done those. And to me, the lowest risk time to do is the beginning of a cycle, value add, and you got the wind at your back, rents are going up, the economy is resetting. And that's the time, if you're going to do it. I prefer to be in a 7 or 10 year. To me, really short term is like 3 years or less. 5 years is like the border line for me.
Now, apart from negative leverage that you saw over the last few years, sponsors, again, we're kind of focused on commercial real estate, including apartments, perhaps particularly apartments. What other missteps have you been aware of that sponsors have been making towards the end of this cycle? Yeah,
one thing that very much concerned me and frankly annoyed me, honestly, was that pref equity was starting to be used even when they were using agency debt to do their value add. That started in 2017-18 that I saw that really started to creep up. And that was to basically they were basically just trying to leverage investors to get a higher return. And I think a lot of investors that I spoke to during that time had never invested in pref equity before, didn't understand exactly how it worked. A lot of them already been in it. They invest, then they wouldn't understand because they just look at this fixed high interest rate and they'd be sucked into it. And so I was very disappointed by the extreme nature of where we got to into the high 80s on very common deals, including the pref equity stack. To me, that's completely irresponsible. And I'm not trying to point a finger at any specific, but I'm just saying objectively, just numerically, if you're looking at it on a spreadsheet, that seems like very, very high.
And what about other underwriting criteria,
Yes.
rents and etc.?
Yeah, so that's a good question. Adam, have you ever seen a sponsor in all of you've been in this for years like me, you ever seen a sponsor project a reduction in rents in, let's say, a 10-year pro forma?
It is really funny that you should say that. Yes, once.
I've only seen it once. I've seen it once.
It was a self-storage guy.
Okay.
And and I looked at his pro forma. He was out. I was doing a course on how to invest in self-storage. This is years ago, probably 9 years ago. And I looked at his pro forma and I said, wait a minute, your rents are coming down in year 4 or something, whatever it was. I said, why is that in there? He said, because we think there's going to be a recession, so we're building it in.
Yeah, I invested once in an apartment deal in 2013. There was a reduction between 16 and 17. They had thought the recession was going to be sometime in 16. Same question, same answer. Never seen it before, never seen it since.
Right. Okay? Almost.
Yeah, and this is, I started in 2002. This is 20-something years later, right? So that's how rare that is. But how often do we have a recession once in 10 years? Very often, right? Now, recently with the money printing, actually the timelines have kind of strung out a little. But so, that's one challenge, of course, that you see with assumptions, because you don't ever see that really. Another challenge we saw in the last few years was just the estimation of very high rent growth. Now, keep in mind, as soon as I saw something that's a floating rate loan, I just put in the garbage. So I didn't look at most of the underwriting in the last few years, to be totally fair, right? But from what I've seen and heard, people were assuming in some cases, 10, 20% rent growth in certain very hot markets because that's what was actually occurring. And to me, again, that just seems, the word irresponsible on me isn't fair because it depends on the deal and the scenario and where rents are before they get the value add going. But it just seems ultra aggressive to be nice about it, and something if you're an investor you really have to think about, for sure.
Okay, look, I believe it or not, Jeremy, seriously, I saw an ad for a deal on Facebook, like within the last couple of weeks, where they were still projecting 2.4% rent growth per month.
Per month.
Gotta be kidding me. Per month. Still. That was for a Florida deal. And Florida had that kind of, and I just, how could you it's mind-blowing to me that people would still have the gall to even present something like that to investors in this market. So let me ask you, 10-year deals, you stopped in 16 to almost 2024. So presumably you were investing before that. So some of those 10-year loans are coming due. So how's your investment philosophy served you, and how does that look over the next year or two?
Yeah, well, so it served me extremely well to date. It's about to be tested, obviously. I honestly, I'm in one senior housing deal that had a problem with COVID and other staffing problems. That's a bit of a different animal of an asset class. But besides that, I'm in a few retail deals that are going to have to refi in the next 2 years, but because they were 10-year fully amortized loans, and also we got to remember rent increases have happened over the course of 10 years. I'm pretty sure we're going to be fine based on the initial numbers. We'll have to see. So one of the benefits you get of doing a 10-year outlook and a 10-year fixed rate loan, as long as you're getting a fully amortized loan, because I've seen deals that are 10-year like interest only if they can get them. And even though you get a lot of the cash flow back, more cash flow back earlier, and technically the IRR could be higher, one of the risks is that you end up in this type of challenge. You don't get the mortgage pay down because there is a reduced risk by being fully amortized, right? So personally, I'm really not very concerned, thankfully, about my situation at all. I'm very lucky just because I took the approach that I took. And all I'm doing is, and I have to tell you that the difference between this cycle and last cycle is that this cycle, I feel really bad because I know a lot of people who are already being hurt by this, everything that's been going on, whether it's an LP or a GP, and I feel quite awful. Last cycle, I was newer. I didn't know as many people, so it wasn't quite as personal and all that. But for me, I'm just waiting with some cash that are in treasuries, and I'm rolling those treasuries every 3-4 months to maximize the interest rate. And I'm waiting until we see what happens here. And I think we're going to be in a very good time to invest next year or the year after. But I want to remind everybody, real estate moves very, very slowly. I'd rather be too late than too early. That is very essential to remember.
So what will be the indicators to you to decide it's time? You've kind of alluded to some of them already. But what are you looking for in commercial real estate investing that will be the trigger that, okay, it looks like now is a good time to get back in?
So each asset class is different, but just to keep it simple, let's talk about apartments because a lot of people pay attention to those. The positive leverage. To me, if I see something at 100 basis points or higher, I'm probably going to be inclined to seriously look at it. Anything that's below 75 basis point positive leverage is going to be very difficult for me to get on sidelines. The best I've seen so far in a non-unique situation like tax abated is probably 40 basis points. And that was more of like a secondary, tertiary market, which was not, that could be happening in those types of markets. I stay away from the real tertiary. But that's the number one indicator for myself. The tricky part for me is because I'm not really comfortable with heavy value add. If something's really truly distressed beyond just a capital stack, but in the operation, et cetera, I'm going to have to pick and choose. Am I really comfortable going into this where something's a little more obvious? Someone's taking over something very distressed and it's a turnaround. That's not necessarily the right fit for me, because one of the challenges I have is I'm looking for a pretty high level of cash flow year one because I live off the cash flow. So I have, like everybody else, I have a limited capital to invest. And so I got to maximize the cash flow. So that's going to be another marker for me. If I see a distressed deal, but it's offering 3% cash flow projected year one and maybe up to 10 year two for some reason, that's not going to be a fit for me.
Right. You have a specific cash flow hurdle, don't you, on your money?
Well, what I do is I wait for everything to reset, and then I actually create target for each asset class at the beginning of a cycle. And that's how I know when to stop. When I told you I drop off everything, when things get too expensive, it means that they're not cash flowing to the extent that I need them to in year one at a typical market rate. And that's where I get concerned the prices do. That's actually how I manage that whole cycle for myself. So I can't tell you what my target's going to be because it's going to be a question of interest rates and cap rates, because I can't just say I want 10% if the market is never going to bear it for the next 20 years, right? So I want to see what the market's going to offer and then really fine tune that at the beginning. I can tell you personally, I like to be at 8% or higher year one projected in a very diversified, non-institutional property with an experienced sponsor in a pretty decent location, and typically A- or B+ property.
What have you seen have been the trends in real estate syndication over the last few years, and how have you seen it changing? Since the global financial crisis, obviously we're alluding to jobs, crowdfunding, etc.
Yeah. So so I mean, look, I think you may know this, but I was an advisor for Realty Mogul, who was one of the, if not the first large portal that launched in crowdfunding, and I was on their investment committee for a while, and I actually helped underwrite their initial deals, et cetera. So I'm somewhat familiar with that. There has been, especially with the Jobs Act, with Red D 506C, that I think was able to launch in 2015, if I remember correctly.
Around then, yeah.
The public marketing to accredited investors has really changed a lot. But what I think is about to happen, from what I understand, is that I think that's about to revert, because there's talk about the changing or updating of the accredited investor definition. And everybody seems to have a different opinion about it. But some people think it's going to go to 10 million net worth. Some people think it's going to go to 3 million net worth. It hasn't been adjusted, I think, since the early 80s
1982.
or 70s. Yeah. So there's definitely cause to do that. But I think that if you do that, there's a lot of accredited investors who have a net worth of 1 to 3 million. If you go 3 million or higher, I mean, it's a high percentage if you look at the stats, right? So that's really going to knock out a lot of people from being able to look at this, and it's going to counteract a lot of that advertising. But the public marketing definitely made a huge difference. Because of that, I think a lot of more just, people with W-2s became aware of this type of investing. And that has really been a big change. It's just a lot more awareness and more capital that flowed in. But I do want to say something. You hear about all this capital on the sidelines, right? I believe it to an extent on institutional investing, but not in non-institutional investing. I don't see that at all. In fact, it's become much more difficult to raise capital. And even in the past couple of months, from what I've heard, beyond like the past year. And I'm anticipating if we do have a recession, which is the high probability scenario right now, based on a lot of indicators, that it's going to be even harder to raise capital, let's say next year and the year after. I don't see where there's capital lying around if it becomes even harder and harder on the LP side. That's not the reality.
It's really interesting. So that's a really interesting point. Actually dovetails into tease up my next question, which was, how should LPs be viewing the market today, especially
Yeah.
those who rushed in, didn't have necessarily the same sleep at night standards that you did, and who have invested in deals that are today struggling?
So the first thing I say, and I'm not the best person to answer this because, again, I haven't analyzed these floating rate bridge and I haven't analyzed rescue deal and all the stuff that goes into it. But what I will say generically is, in my opinion, there's two dominoes that we have that are going to fall in this reset. The first one has already fallen. Interest rates have gone up. Everyone's seen the effect of those. The second one has not happened yet. I think we have very high probability of a recession. And what is the recession playbook in real estate? It's typically rents go down because vacancies go up. And you have reduced, and by the way, this is during a time when expenses are going up, right? So NOIs are going to come down, right? And that means, and by the way, this is also in a time where if that actually happens, typically the stock market takes another leg down, which makes more fear, which reduces people interest in investing. They're scared. So you have less capital to invest. So when you combine all that, you have higher cap rates, lower NOIs, lower value of a building, even beyond today, just from the economic forces of lower revenues and higher expenses, right? That's kind of part two of this. So if you're in a situation where you're being asked to provide money into a capital call, you have to take a really hard look at what you personally think is coming up with the economy in the next 12 to 24 months. If you believe there's going to be a recession, you've got to look at the assumptions that were made based on the amount of capital that's being asked for in this cash call. And do you agree with where things are going to be in a year or two? Because if you're rescuing a property based off of very positive assumptions and you don't believe that those are actually realistic, it may make sense for you not to participate in a capital call if you think you're putting bad money after good, right? And
good
so
money after bad.
Good money after bad, whatever the expression is. So, but I think what I'm concerned about is I don't think enough investors are going to actually do stress tests and scenarios and ask the sponsors to run them. A lot of them are going to take the assumptions and not factor in. I think everyone's talking about interest rates. People are not talking about the effect of a recession.
Yes, a very interesting point. Actually, I asked you what experience you've had going through a downturn. The first experience I had was in the late 1980s, savings and loan. And my job at the time was to raise money for a ground up multifamily sponsor. I raised a lot of money for them.
Oh.
And one of the things that I remember was, I do remember, in those days, I was totally green. I was just like amazing. We were making hand over fist. We were driving around. I was 25 or whatever, driving around in a Mercedes. I had this great apartment. I was living the high life. Everybody else, and I do remember a couple of things. One, the term "this time is different." That's what I heard a lot. And I didn't know what they meant. They were like, what, different from what? I wasn't sure what they were talking about. And then in hindsight, of course, I realized what they were talking about. One of the first signs, and I wasn't really consciously aware of it at the time, it was only in hindsight I realized it, was driving around because we were building ground up, right? And then leasing them up, stabilizing and selling them. Yeah. I noticed these big, kind of clumsily hung signs on new built multifamily properties that said 2 months free rent, concessions, in other words. And it has always struck me that the first sign of a serious recession in especially multifamily is when you start to see concessions. And I just saw an article. It's something I like. LinkedIn is a really good source, I find, for information. Yes. Very detailed analysis about the proliferation of concessions.
Yes.
It creates this kind of false idea that rents are still at this high level, but in reality, they're not. That's the first shoe to drop.
Yes, that's already happening now. And it's very common, half a month, in some cases up to 2 months. I know a lot of people consider 2 months quite extreme, but I think it's going to be very common at some point in some major cities.
Oh yeah, I'll see if I can dig it up and put it on the show notes page. This was talking about 2 and 3 months concessions, buildings competing against each other that are coming out of the ground. Inevitably, it just starts to push rents down. I mean, that's what it is. It's a discount on rent. Yeah.
So I'd like to just make 2 more points here. First is this time is different to me is like soft landing. If you actually look at Google searches in 2009, there's actually an equivalent number of searches now than there is actually used. The term was used as much in 2009 as it is today. Most people probably don't realize that. And it's the Fed and the government trying to get this narrative out and that they front run is a likely recession, and they just try to get the narrative up to try to make the recession less impactful. So that's actually a normal thing that's happening. It's not anything new, and it's not like everyone has this opinion. It's just a normal thing that happens. The other thing I'll say, though, is that, this whole soft landing, we've had a record long economic cycle. We haven't had a recession yet. I mean, some people argue we had a minor recession during COVID. It was a technical recession, probably wasn't real because of all the money printing, right? So if you assume we haven't had a reset yet, anyone that says there's a soft landing means that there's no recession. Does that mean that person believes that economic cycles are now gone? Like, we're not going to have a recession for 20 years, including the time we've already had, plus the next cycle up? That, anything's possible. So nobody knows for sure what's going to happen. But the way that I work is I work with probabilities. And right now, the probability is extremely high of a recession. But most people aren't talking about it yet. But that is the next domino that is most probable to fall. Not necessarily 100% for sure, but that's the probability. And that's what we really need to go with to protect ourselves.
Well, look, Jeremy, there's no doubt. I don't know if you would agree or disagree with me. The definition of recession, what is it exactly? But in commercial real estate, there is a hard recession in commercial real estate today.
Oh, yeah.
30% declines in value. I mean, this is hardcore.
Yeah. Have you heard anybody say that real estate has crashed? Have you heard that?
Only me.
Okay. So let's put that aside. If I said to you, any asset, stock market, is down 25 to 30%, would you not agree that that's a crash? And when I ask that question to people, everybody says yes, because I definitely kind of change people's perspective on this. And yet nobody is just using the word crash, which is shocking because we've had a crash. It's really that simple. And I don't know whether that's because the sponsors that are currently dealing with the challenges are staying away from using that word psychologically. I don't know if that's the government also I think everybody trying to stay away from, but factually, objectively speaking, just like we're likely going to have a recession, we've had a crash now. We're in the middle of a crash.
Yeah, it's hard not to see it any other way. So let me ask you a couple final questions as we start to wrap up. First of all, I'm fascinated. 3 to 4 hours of reading every day. OMG, I spend at least that much time reading, but usually it's just emails and like stuff I actually need to act on.
Yes.
What is your interpretation of the market at the moment? You've talked about high percentage transfer. Kind of just give me an overall macroeconomic view of what's going on, what's really driving things at the moment.
Sure, and I would say it's really 2 to 3, not 3. It depends on the day, but usually 2 to 3 hours. So where I think we stand today is, the Fed just paused hiking rates, and we'll see what happens in December. In my opinion, what we're about to deal with is it seems as though Powell is trying to buy some time to determine the lagging effects of what has already happened to see how it's going to, funnel through the system. I think that I don't know how long he's going to wait to see, how that pans out. I think that we have one thing that I'm very carefully focused on is oil. Based on the war in the Middle East, because if certain key countries like Iran get involved, the price of oil can skyrocket, and that will actually completely U-turn inflation going back up. And so that's a major risk as a side note to watch very carefully, because that could lead to increase in interest rates quite quickly again. And otherwise, we're in a bit of a holding pattern from the Fed's perspective. He wants to see how things are going to play out. Q4 GDP is going to be really key. The Atlanta Fed, which is the one that's kind of recognized as being somewhat one of the most accurate sources to look at the GDP, is currently projecting 1.2% GDP as of today for Q4, which is what they just actually literally just reduced yesterday from 2.3%. So it's quickly coming down in its estimates. If we get into the 0.5 range or lower or around that, that's when you start to wonder, okay, are we going to have a Q4 negative GDP? And how's that going to impact psychology? How's that going to impact the media? How's that going to impact consumers, right? Because psychology is very important. 70% of GDP is consumer spending. So in the next few months, that's what I'm paying very, very close attention to. In the meantime, on the actual investing side of things, from a macro perspective, I'm just waiting for the slow grind of the sellers eventually adjusting their prices to reflect the reality of the market today. It happens every time. It's a normal thing in a cycle. Real estate moves slowly. That's why I said you can better be late than early. And so it's just the continued agonizing wait is what it is while we assess what's going on with the economy. So those are some of the highlights at the moment.
All right, and last question then. So opportunities, investment opportunities in commercial real estate going into 24, perhaps into 25. What are you looking for? Where do you see those opportunities likely?
Yeah. So so there's 1,000 ways to invest, none of them are wrong, but my personal focus with more predictable cash flow is going to be on several specific asset classes and what I'm going to try to position myself into for the next 10 years based on where I think, some of them I think were more predictable than others. So I'll be focused on apartments, mobile home parks, and self-storage. I'm probably going to dip my toe in some others as well, but those are my primary targets. When I think to myself, where those going to be in 10 years, most likely, right? I can kind of see where they're going to be and for the most part. Whereas let's say office, retail, and industrial, much harder to forecast where that's going to be in 10 years due to the internet, due to working from home, and due to other factors, right? And so I'll be watching those asset classes carefully for resets and watching for that positive leverage. And then I'm going to be re-engaging with specific sponsors who I've had in mind for a while to start the process of looking at what they're doing. And, that's going to start in early 2004 is re-engaging those relationships, not because I want to invest in January of 24, but because I want to follow somebody, see what they're up to, and make sure I'm going to see what they're going to do and really be in the queue to see the deals they're going to get.
Jeremy Roll, President Roll Investment Group. What an enormous pleasure. I'm so happy that we actually met today.
Yes.
We've spoken so many times over the years, but thank you for joining me on the podcast today.
Yes, and thank you again for doing what you do with this. It's just what you're doing is very important right now. People have to be very careful. If you're watching this and this is the first podcast you've seen of Adam's, go back into his catalog. He has not paid me to say this, but go back into his catalog and look at some of the previous interviews. A lot of them, even from the past, even a year ago, are highly relevant today. And some of them institutional, some of it's non-institutional. You got to pick your ones that make sense for you. But if you want to understand what's going on beneath the surface and what's going on in this crash, it's very important to watch some of this.
I'm just going to tell you that we do pick at what I call an impactful clip from all of these. I'm just going to use that.
Fair enough. Fair enough.
I'll put it out on social media for the next 6 months daily.
Yes, but no, seriously, thank you for helping the community.
Yeah, I really appreciate it. Thank you, Jeremy. All right, that was my conversation with Jeremy Roll, president of the Roll Investment Group. Jeremy, as you see, is probably one of the most conservative investors you'll come across, even more conservative than I am in some regards. And if you want to know more about Jeremy, just go to the podcast page at gowercrowd.com. I'll include some links to Jeremy so you can learn more about him. And while you're there, of course, do please subscribe to our weekly newsletter. Jeremy, what a pleasure it was to actually meet you. I know it's strange to say that, but these days we do meet on Zoom. It was the first time we've met face to face, and it was a real pleasure. I enjoyed our conversation that we just presented in this show, but I also enjoyed our chat before and afterwards. And thank you too, dear viewers, for joining us today. I really appreciate your time and that you took the time out to join us and to listen to this episode. I hope you found it of interest and of value. All right, that's it for today. Until next time, this is Adam Gower signing off.